Welcome back. We have been discussing the just concluded earnings season, which has been followed up or accompanied by an extraordinary rise in stock prices as well. We are now in blue skies as far as the Nifty is concerned. Joining us to tell us whether this Nifty rally has legs to run, whether we should look at outside Nifty stocks in terms of earnings growth and PE catch-up, we have Gautam Duggad, Head of Research Institutional Equities at Motilal Oswal Financial Services. Gautam, good morning. Thank you very much. Can you quickly wrap up for us the highlights of your earnings finds? They look so good. Best earnings season in what, 5-6 years?
Hi, Radha. Yes, it's been one of the best earnings seasons so far. At least the first earnings season in my practice of doing this strategy for last 21 quarters, where I had to upgrade the earnings materially.
Ooh.
So the highlights are very simple. You've seen a 17% Nifty profit growth. We were expecting a 5% or 6% decline.
Ooh.
So it's a 25% beat. And even for my broader universe of 200 stock in Motilal Oswal coverage universe, we have seen a 16% profit growth against an expectation of a 7% decline. So all in all, it's a 25% earnings beat at an aggregate level. More importantly, you have seen operating margin expansion for every single sector except capital goods and utility. So it's been a fairly broad-based beat. 63% companies in Nifty universe have beaten our expectations. Upgrade to downgrade ratio is 4:1. So we have seen 107 companies with earnings upgrade of more than 5% and downgrade of more than 5% for just about 27 companies.
Got it.
Normally the ratio is the reverse. And lastly, we have upgraded Nifty EPS by 9% for FY21. So we are now at 497. So essentially you can say that if this 497 number is met, we will end with a positive 6-7% earnings growth for a year, which has been ravaged by pandemic and lockdowns and all sort of things. So not a bad earnings season all in all, and more importantly, the commentary for third quarter has been equally good.
Got that.
You're not festive season.
Yeah, got that. Gautam, good morning. But how much of this is because of cost control, in terms of margin improvement, and how much of this has been pure top-down beat?
So it's the cost control has played a significant part, Anuj. We have seen a 7% sales decline and still a 9% EBITDA growth. So there has been virtually 14-15% cost decline across sectors. In some sector, it has been other expenses. In some sector, it's been advertising or staff cost and number of things. But that is what has caught us by surprise. In 1QFY21 also there was a cost control, and we did not expect that the magnitude of cost cut will be continuing in second quarter as well. At some point of time, some of these costs are going to come back. But as most of the corporates have been saying, not all costs are going to come back. They've defined some costs as good costs, some as bad costs. So some of the costs are going to make a comeback. But then it will be counterbalanced by the top line recovery as well, Anuj, because if things are opening up, there will be some recovery in top line. So it will have to be a very sector by sector approach when you start forecasting earnings for FY22, depending on the opening of the economy, how much of this cost control sustain. For example, third quarter, we are expecting earnings to grow just 10% now after 17%. So extent of surprise will be limited now. Most of the cost cuts will now get factored into the estimates. Maybe you will not get such a big surprise in the second half.
Okay, since you said sector by sector, let me talk about that. Gautam, good morning. The two sectors which stand out for me, where there was not only year-on-year growth, but there was also positive commentary from the management, is cement and paints. In either of these sectors, do you see more upsides both in the stocks and in earnings?
Stock price upside, very difficult to forecast, Sonia. We couldn't forecast 12,800 Nifty way back in April. So I will keep that aside. Yes, earnings, cement has been a blockbuster quarter. We have seen a 93% profit growth for our coverage universe. Every single stock in cement sector has beaten our expectations. Volumes were stable. More importantly, there was a very strong price discipline that we saw in cement. And then you also saw cost control. And now with things opening up, construction coming back, affordable housing and all sort of things on infrastructure, execution picking up, the possibility of buoyancy in cement volumes can continue. Some of the costs have started going up, power and fuel and some of the logistics costs. So maybe the extent of margin expansion will be limited. But this is the one cyclical sector which I have always liked. Most of the other cyclical commodity sectors I have avoided for last 3-4 years. Cement we have always liked, given the strength of the balance sheet, cash flows, quality of management, and relatively stronger pricing discipline across the sector.
Okay, Gautam, you tell us, let me try and ask you a question like this. If you were to get another 100 rupees, incremental 100 rupees to invest for a 1-year return, what will the split be between Nifty and non-Nifty? And within mid-caps, how would you place them?
Yeah, sorry, I forgot to answer the paints question
Okay,
that Sonia
sure,
asked.
please.
Paint has been a forever green sector. You've seen 10-11% volume growth in an environment like this, and companies like Asian Paint, Berger, their commentary has been rock solid. Margin expansion has been also equally strong. In sectors, the only question is when do you want to enter, because the valuations never allow you that comfort. Coming to Lata, your question, out of 100 rupees, I will put 70 rupees in Nifty, 30 rupees in non-Nifty. And within 70 also, my bias will be very high towards BFSI. If you remember the last conversation also, and even if you go back to June, July, I've been telling you that BFSI is the best recovery trade in India. Some of it is already played out, 30-40% rally we have seen in large cap private sector banks. But the way things are, I won't be surprised if this is the sector which drives Nifty further higher, because the level of provisioning coverage ratios in some of the large cap private sector banks are upward to 70-80%. And if you see some amount of loan growth coming back, then this sector still has more legs to surprise on earnings.
Okay. So
on mid caps, incrementally, we are getting more and more constructive, but I'm still not going to be indiscriminately in favor of mid caps. We have our preference of top 10 or 15 ideas, which we want to stick to at this stage.
Got it. Gautam, where does Reliance fit in all of this? It had that big move to 2,300, but now it's seen some serious profit taking on this one.
I know a lot of these stocks which have played their part in the rally, they can have some time correction, which is quite natural. You have seen Infosys taking a breather, TCS taking a breather, Hindustan Lever has been taking a breather. So that's not unusual. In fact, some of the pharma large caps also are now taking some time correction, which is quite okay. But the way Reliance story has played out, it tells you something, that there is very little that we know in some stocks in terms of our ability to forecast and predict. So the most pragmatic way for stocks like Reliance, which has a 14% Nifty index weight, or maybe now 12%, is to keep it equal weight and then evaluate more and more triggers going forward. I think there is no big near-term trigger which is left now. The fundraising, the deleveraging of the balance sheet has played out. We'll have to see how the geo-related ARPU improvement plays out, and then what happens to the retail listing over a period of time.
Okay, but even in terms of BFSI, you're going to give 70 rupees to the Nifty BFSI, No, I said 70 within Nifty. 70 within Nifty, not 70 within Nifty BFSI. No. If I were to give you 100 rupees for BFSI, how will that be split? Will it go to Nifty BFSI?
No, it will be a mix of Nifty and non-Nifty, because a lot of insurance, wealth management, capital market firms, basically non-lending financials do not have as much representation in Nifty as they have in the financials pack. So large part of my allocation within BFSI will still go to large cap private sector banks, followed by some of the high quality NBFCs, and then some non-lending financials like insurance, names like ICICI Securities, which are seeing a huge buoyancy in retail volumes as well as operating leverage story playing out. So it will be a mix, Lata.
Okay, I just have one final question to ask you, because these are the buzzing spaces to be in right now.
Airlines.
I don't notice them on your list. Hotels, airlines and real estate. So any of these spaces that you think there's more to go?
Yeah, I mean, Sonia, they've given stellar returns in the last 40 days ever since the news of vaccine came out, and then, things opening up. We have liked Indian hotels. We have missed out on Indigo. We've had a neutral rating, and obviously, the way PLFs, some of the data points that are coming out, while the airline numbers are still way below pre-COVID, the stock prices are at least 30-20% ahead of their pre-COVID stock prices. So I would be cautious there now. Anyways, it's a very highly cyclical play. So I don't want to jump in when the stock prices have moved out a whole lot. I will wait for a correction. From a recovery point of view, let me just say that we are far more sanguine on consumer discretionary names. BFSI I already spoke about. And then some of this building material, home improvement space, which are also play on the rising, discretionary consumption that we are seeing now.
Okay. We can go on and on. Unfortunately, out of time. Gautam, it was a pleasure speaking with you. Thank you very much for joining us with such a detailed analysis of the quarter that was and the quarters that will be. We are time out on Bazaar. Trading ideas lined up for you on Chart Pass.